The concept of economic income is covered in the corporate finance topic under the reading on capital budgeting. So economic income is defined as the cash flow in a particular year plus the change in market value. For the change in market value, we can express it as the difference between the ending market value minus the beginning market value. Now, of course, we could rewrite this as the cash flow minus the difference between the beginning market value and the ending market value. And the difference in the parentheses is what we call the economic depreciation. Now, if we were to take the economic income divided by the beginning market value, we would get what we call the economic rate of return. Now, let's look at an example. So we have the after-tax cash flow for a project, for example, for a life of 5 years. So there is an initial outlay followed by cash inflows for that period of 5 years. So let's say if you have to calculate the economic income in year 2, and we'll assume that the weighted average cost of capital is 20%. Now what we'll do is we will already have the cash flow in year 2, which is 80,000. Okay, but we need to also find the economic depreciation, which is we will need the beginning market value minus the ending market value. So we'll start by calculating the beginning market value in year 2. So that is equivalent to the end of year 1. So assuming that you are now at the end of year 1, so you still have these 4 cash flows to receive. Okay, there's still 4 more cash inflows here. Okay, then if you move to the end of year 2, which is the ending market value, then you only have 3 more cash flows to receive. Okay, so this is the end of year 2. This is the beginning of year 2, or the end of year 1. So we'll now start by calculating the beginning market value in year 2. So it's just a net present value calculation. So using your calculator, let's press the CF on this worksheet. Your initial cash flow is 0 in year 1, okay, in this end of year 1. Then CO1 is 80,000. Okay, and then CO2 is 120,000. And CO3 is 140,000. And CO4 is 200,000. Right, then your press NPV, your I is equals to 20, and then we'll compute the NPV. So that's 327,469.14. Now we'll calculate the ending market value at the end of year 2, where we'll have 3 more cash inflows remaining. So for that part, again, we'll just do another NPV calculation, but we do not have to re-enter everything. What you will do here is move back to the cash flow worksheet. Okay, we just need to delete the cash flow for 80,000. So just scroll down to CO1, 80,000. Just press second and up button to activate the delete function. So now all the cash flows from the year 2, 3, and 4 are moved forward. Okay, so now the first cash flow is 120,000 followed by 140 and 200. Okay, so you do not have to re-enter everything. And then just click NPV, scroll down and compute. So this is the ending market value for year 2. So that's 312,962.96. So with that done, we can now compute the economic income, which is the after-tax cash flow of 80,000 in year 2, and then we'll minus the difference, which is the beginning market value minus the ending market value. So this will be equals $65,493.82. Okay, so that's the economic income in year 2. If we were to calculate the economic rate of return in year 2 by taking the economic income divided by the beginning market value, so using the numbers that we have computed before, this is 65,493.82 divided by the beginning market value, 327,469.14. So that will be equals to approximately 20%. Okay, so that is also the WACC that we had used to discount the cash flows earlier. Now, another alternative method to calculate the economic income is to take the economic rate of return multiplied by the beginning market value. And of course, here the economic rate of return is 20%, which is the WACC in this case. So we could have just taken 20% multiplied by the beginning market value, 327,469.14. Okay, and that will give us 65,493.828. Okay, so that's very close to the answer that we obtained earlier, but slight rounding error in the second decimal place. Okay, but nevertheless, this is also a short way of getting the economic income. You just need to calculate the beginning market value and multiply that by the discount rate, which in this case is WACC.